Welcome everyone to presentation of our FY22 annual results. I'm super happy to have so many of you here today. Look forward to taking you through the presentation. I'm going to take you through a summary of the year. Ollie will then come and talk to you about financials and ESG numbers. As you know, we prioritize ESG alongside our financials. I'll take you through our commercial and impact vision, taking it through to March of 2025. I'll go through some operational highlights and associated outlook, and then we'll go to questions. So moving on rapidly through to the summary of the year. And so delighted to report revenues of 79.7 million, up 58% on the year before and up 16%, including 16% on a like-for-like organic basis. Adjusted EBITDA at 12.2 million, up 72% on the year before, EPS up 52%. And, you know, as people who've heard us speak before know that we're very focused on cash generation, cash conversion, and I'm pleased to see 110% cash conversion ratio through the period. We saw our workforce grow by 22% to over 600 people, with 47% of our workforce being women. Numbers that we'll run through on the ESG side, but one that I'm always particularly proud of is the carbon intensity per £1 million of revenue, down pretty much 9% year on year. This is quite tough to do. And I'm really proud that we focus on this as a key measure as we continue to grow. We kickstarted about 1,200 careers versus our goal of reaching 5,000 by March 25. And our people donated nearly 2,000 hours. We give our people 2 days to donate on an annual basis. And so we're delighted with that and some of the organizations that we've supported through that. In terms of our revenue, the sectors we operate in, commercial sector 28%, government 58%, NGOs 8%, and charities, trusts and foundations 6%. Further split of that, you see that central government was 35%, local government 17%, health was 9%, and you can see the other sectors there. In terms of the market that we sell into, the digital transformation market, particularly in the UK, particularly in public sector, there are a few things here. So firstly, spend in public sector in the UK on software and IT services grew by 9.9% last year, split into 3 different segments that we operate in. So consulting, solutions and operations. Obviously, we're not a software company. You can see the split there that they grew by. And, you know, forecasters continue to increase at circa 5% a year for the coming few years as well. But the big thing is that the chart you see on the bottom right-hand side there, which is the blue and green. Blue being the spend on new cloud-based modern architectures, modern technologies, and green being the spend on old legacy products and services. And as you see, in 2022, we crossed over the 50% mark for the first time. And, you know, bear in mind that we as a company tend to operate only in that blue space and don't have any legacy operations. That's the market that we're selling into, which is why at a macro level, kind of regardless of what's going on in the world around recession or any of the other issues that are going on right now, government will continue to spend on it needs to spend on modernizing its underlying technology if it's to achieve its policy goals going forward, regardless of which government is in, regardless of which prime minister comes in the next few weeks, and what their kind of individual policy priorities might be. The underlying infrastructure has to change to meet the needs of a modern society. Moving on, some of our clients on here. You know, we're super proud to continue to focus on clients where we can deliver the biggest impact. And impact isn't just pretty obvious, I guess, that you deliver impact when you work in public services, but even in clients like HSBC, you know, one of the things that we're doing in there is working with them to get their global people data so that they can begin to address some of the DE&I challenges that they face within their organization. So impactful work at that level as well. And you know, as you see a real spread there across local government, not-for-profit, central government, and a whole bunch of sectors. For example, utilities there on the bottom right with Wales and West. Moving on to where we are today. So those of you who followed us for a long time know that we've been kind of building this jigsaw puzzle of capabilities to deliver on a holistic transformation offer. I'm really happy to say that we are now in a position where we can claim to be a full service, holistic digital transformation company with a capability of delivering everything from organization design and change at one side, right the way through to running services on a managed service basis on the other, and everything in between. And the acquisitions, which we'll talk about later, around of Peak and Swirl, which are post period end, that just we closed those just after the year end. Both, have really filled out that capability for us. So, and as a consequence of all of that, and moving on to the next slide, as a consequence of all of that, we can deliver some really spectacular work. I mean, Welsh Ambulance Service Trust is a good example of, really the kind of work that we'd love to roll out in other parts of the country, of the UK, and I'm sure actually would be much needed. I mean, in there, what we're able to do is offer the Welsh Ambulance Service Trust, give them a real-time view, actually refreshed every 60 seconds, but a view of where all the ambulances are across Wales, but also give them an overlay view of where there's capacity in A&E departments, so that they can route ambulances to where there's capacity. So you're going to try and avoid these queuing up things that we've seen in the news many times in recent weeks. UNICEF has been a wholesale change in the way that organization works. Their way of working has completely changed, resulting in significant improvements in efficiency, significant improvements in staff satisfaction, and I'm a really super happy client there, and obviously hugely impactful. And then Rural Payments Agency is another example. We took over, this is several years now that we've been running this, and in fact post-period end we just took another renewal and a project to re-platform. But Rural Payments Agency was previously being run by another company at a cost of £34 million a year, and actually it didn't work very well. We took it over, rebuilt it, re-architected it, and been running it on an ongoing basis since then. Substantially more run far better than it ever has been, and in terms of payments made to landowners and farmers, and being run for 5.5 million a year, so £28.5 million a year saving for you all as taxpayers. So look, that's a quick overview. I'll hand over to Ollie.
Thanks very much, Neil. Good afternoon, everyone. Nice to see you. I don't think there's ever been a more appropriate slide or picture on a slide than that one, given today's weather. I hope everyone is safe and well and not melting too much. I think it just highlights, again, us presenting our financial and ESG messages together side by side. It's core to who we are, that we believe in profit and purpose side by side. As I say, never a more appropriate day to reflect on that than today. That aside, so in terms of the financial results, it's been an incredibly strong year again. We've seen revenue increase 58% to 79.7 million. That includes like-for-like organic growth of 16%. The remainder of the growth coming from acquisitions, full year impact of acquisitions in FY21, plus part year impact of Red Cortex and Nudge. The adjusted EBITDA was up 72% to 12.2 million. Incredibly strong performance there, and we saw EBITDA margin increase by 1% to 15%, largely as a result of that cost base remaining flat as we've grown revenue. In terms of adjusted profit after tax, that was 8.7 million in the year, up 67%. We also made our first statutory profit, although again, I reflect that the statutory numbers are not necessarily the most relevant metric to look at us based on, and we'll cover a bit more of that in a minute. That profit translated into a significant increase in EPS, up 52% to 9.4p. I'll talk through that calculation in a bit more detail. Cash conversion remained strong, so we saw very strong cash conversion at 110%. Cash at the year end was 7.9 million. We saw an increase in net debt from 7.3 million to 10.1 million, largely as a result of the acquisitions we made in the year, where cash outflow was circa £8 million, which was then supported by an increase in our banking facilities. Worth noting that post-period end, we have extended our RCF facility from 20 million to 30 million, giving us £11 million worth of headroom for further acquisitions. Interestingly, it's also a sustainability-linked loan, which gives us some margin relief if we hit our sustainability goals, which again aligns our profit and purpose, which is good. In terms of sales backlog, this increased 5.6% to 41.2 million. Given the other scale of the metrics, I guess this looks disappointing, but in reality, it's just a timing discrepancy. At the end of last year, we had a number of large contracts that have recently been tendered. Obviously, they have been spent and drawn down over the course of FY 2022 and into FY 23, and we're looking to retender those. So that's just a timing of some of those large contracts and the spend coming off of those off of those contracts. We also pleased to announce a dividend up 50% year on year to final dividend of 0.6p per share, up from 0.4, taking the full year dividend to 0.9p per share against 0.6 in the prior year. The next slide just shows you a little bit of an overview again for anyone who's new to the story of where we've come from and where we've got to. So significant CAGR for both revenue and EBITDA. Obviously, Neal will talk through our commercial vision later on in this presentation, but we're looking to scale to 200 million run rate revenue by March of 2025. In terms of the divisional revenue split, you can see that the majority of revenue currently sits in our consulting, sort of public, which is predominantly public sector focused, with platforms and managed services making up the next highest sector before see experience DX at 19% and international at 14%. In terms of the revenue breakdown, this largely reflects similar positions we showed at the half year. So about north of 30% of our revenue is recurring, so rolling contracts that continue month on month. And we see a high proportion of repeat customers year on year. We always do. Again, digital transformation agenda continues for our customers. If we do a good job, we tend to get invited back. And then in terms of new public and new commercial, the interesting point here is that for the first time ever, we've seen an increase in the new commercial sector, or more commercial work than public sector work. And that's reflected in the fact that we've got 3 commercial clients that should deliver more than 3 million revenue this current year for us. In terms of adjusted EBITDA to statutory EBITDA, some of the adjustments between those two numbers. So we've got some costs relating to acquisitions, but Nudge and Peak, and then we had an aborted acquisition as well. In terms of the costs relating to the change program, they're largely as a result of implementation of new software and processes and organising the group to scale to sort of its next goal of 200 million. There's some share-based payments, and then you've got a gain in the change on fair value of contingent consideration. This is basically historic, relates to previous acquisitions where we had earnouts in place, and in this case we overestimated the amount of consideration that would be payable, and that ends up in a profit number for the year. That should largely disappear from next year. In terms of cash flow, pull out a couple of key items in here. We had discontinued operation in the year, which from a cash flow perspective was about 1.6 million of cash. That was Green Shoot Labs. Green Shoot Labs is was a conversational AI business that we successfully spun out and raised £4 million for to go off on its own journey in May. And that obviously will come out of reduce any cash outflow from that business, won't be going into the current year. I touched on the acquisition, so net cash out of 7.2 million. That's 8 million less some of the cash that we received as part of the acquisitions. And the other number I just highlight is that increase in banking facilities by 5 million. We increased from 13 to 18 million pounds worth of drawdowns with HSBC during the year, but overall a net positive increase in cash, albeit an increase in our net debt position. Just a quick reconciliation looking at our adjusted profit before tax from our statutory number. Again, this is why the statutory profit has never been a particularly appropriate number to measure us on. So we've got significant amortization charge going through the P&L as a result of our acquisitive strategy. So when we acquire businesses, we have to allocate the purchase price against goodwill and intangible assets. Historically, goodwill would be reviewed for impairment, now you have to allocate significant value of that against intangibles, which gets written off over a period. So that charge is not dependent on performance. We've actually got a profit on the fair value movement of contingent consideration, as I mentioned before, against a significant loss in the prior year. Again, it's non-cash and just reflects accounting estimate changes. Sale-based payments, we've seen a slight increase as a result of some incentives we put in place for senior management, as well as some of the teams that have come in as part of the acquisitions. We've got the costs associated with acquisitions and restructuring and the costs relating to the change program in there, as I mentioned before, bringing you down to an adjusted profit before tax of 10.9 and an adjusted profit after tax of 8.7. In terms of adjusted earnings per share, taking that profit after tax number, then looking at the fully diluted number of shares, we've got a weighted average basic share number of 84.5 million shares in the year. We've got the options of 3.7 million, decreased on year as a result of some exercising this time roughly a year ago. Then we've got the maximum number of shares to be issued as a result of previous acquisitions. Significant fall in that year on year, obviously, as a result of us issuing shares in year. That number, 4 million shares, would drop down to about 2 million of shares based on current share prices where they stand today. But yeah, really pleased to see a significant increase in EPS. In terms of our ESG results, another great year on that front too. We continue to support lots of well-paid jobs in the UK. We've got employee base up to 606, 63 new jobs created in the year, which is really good. In terms of our sort of representation, really pleased that we've seen a significant increase in our ethnic minority representation. Actually, we're now in line with the full population of the UK. In terms of female representation, we've seen a minor decrease, but we're still in very good shape around that, up close to 50%. We continue to support charities. I think we invested £59,000 in the current year was given away to charities, and we've seen significant hours donated, as Neal touched on earlier. We've increased our entrepreneur program, our future leaders program, and took in 2 cohorts in the year, including a black focused cohort on the back of the Black Lives Matter movement. Seen a decrease in our tons of carbon per million of revenue, as Neal touched on. So all of that is positive, and we've seen a slight increase in our public sector services. In terms of what we've done and what's in progress, from a people perspective, we've launched new benefits. We've given people increased holiday and brought in some other sort of healthcare benefits, which is great to see. And we've created some employee forums and some employee resource groups to ensure that we provide as an inclusive environment as possible for our teams. And recently, sort of in the in-progress bit, we've just been through some inclusive leadership training for our senior leadership teams, which will have a significant future impact on the organisation, positive impact on the organisation for many years to come. In terms of planet, we've launched our climate employee resource group, and we've committed to donate 1% of revenue to planet related projects. We've had 12 employees switch to an EV scheme, which is good. We are, in the current year, we'll be paying back all historic emissions for the company. From a community perspective, we've implemented a new tool to ensure that community opportunities are being put in front of our employees, and that we can track and measure that, and encourage people to continue to give back to their local communities. And as I mentioned, we've donated £59,000 through investment and giving programs in the year. In terms of our vision, I will hand over to Neal. Thank you.
Great, thanks, Ollie. Right, I'm going to take you through the 2023 and 2025 commercial vision first. Some of you will already know that we'd set ourselves a goal of being 100 million on a run rate basis by March of 23, delivering 12 to 14 million EBITDA. Super pleased to announce that we've achieved that a year ahead of plan in March of 22. And so we set ourselves a new goal of becoming a 200 million revenues on a run rate basis by March of 25. The others kind of largely remain the same. We still intend to keep leverage low. We're committing to keeping leverage below 1.5 times pro forma EBITDA, although our preference is actually nearer 1. It might spike at 1.5 just after a particular acquisition potentially in the future, but then we'd look to see that come down again. We don't want to be an over-leveraged organization. Did you have a strong pipeline of acquisitions? Did you deliver a aggressive dividend policy, as Ollie's talked you through? We're incredibly focused on cash generation. And I think one of the new ones there on the commercial vision is to become a top 20 public sector supplier in the UK by 2025, which, from our perspective, the reason we have that as a goal is we want a seat at the top table. We believe that so much of what goes on in and around digital in the UK government is incredibly inefficient. A new approach is required. We believe we are the organisation to bring that new approach. We recently published a new book, Multiplied, which is talking to government about the opportunities there to use digital to deliver higher levels of impact, and we certainly like to see that follow through. To the next slide is our impact vision that we sits alongside our commercial vision. So as we look towards 2025, working towards halving the 21 representation gaps. Worth noting that from our perspective, we don't believe in quotas. And so it's all about really working much harder from a recruitment perspective to make sure that we've got a diverse pool to recruit from, so that we recruit the very best people. We're always focused on recruiting the very best people and achieving those representation targets. Leave no trace is kind of largely obvious. And I talked earlier about, our goal of kickstarting 5,000 digital careers. And as you saw already, we're really in a strong position to exceed that goal by 2025 as well. So if I move then on to operational highlights for the year and the move to a single brand. So let me pause there and kind of describe to you why we want to move to a single brand. If you look at the organizations that we had acquired, they've done really well. The numbers so far have been brilliant, as you've seen from the compound annual growth rates that you've seen that Ollie presented a bit earlier on. The reality, though, is that those smaller companies had sort of reached their limits, right? They had begun to top out. And as we sort of closed in on that 2023 goal, a year ahead of plan, of reaching 100 million run rate revenue, it was super important that we started to look at what were the limiters, what was going to inhibit us and stop us from becoming a multi-100 million revenue organization in the future. And what we could see is that, those companies that, like most smaller entrepreneurial companies, had typically massively underinvested in business support, business enablement. They were typically over-reliant on some key individuals from an operational perspective. They typically didn't have operational software that could really scale. And, really, this group was a group that ran a lot of spreadsheets and was, massively inefficient in many, many ways. And so last year we made the decision, we bit the bullet and said, right, the thing that we've got to become is a single integrated organization. We've got to grow up as a company. We've got to put the systems and processes into place. We've got to have the back office that enables us to scale and become that organization. So this is way more than a simple rebranding. This is actually a move to a whole new business organization. And, we can see huge benefits that come from it. We have a platform that we continue to build on that will enable us to hit that 2025 goal and beyond. We want to become a professional organization with really the best-in-class operating processes. We want a brand that's known for the breadth of capability that we have. We want a better employee value proposition, and we were able to put the majority of our people onto a new employment contract in the second half of last year, which gave them 30 days of holiday, a series of maternity and paternity benefits, and a series of other benefits as well around ways of working. And ultimately, it's been about allowing us to win bigger deals. I was with the chief exec of Digital Health and Care Wales last week, able to pitch this end-to-end capability, and the level of excitement of finding a company that can actually deliver. We've got proven ability already to deliver a relatively small program of work for them. We now have an ability to really scale that and become a much more significant supplier to them across all of their strategic imperatives. And that ties to the next bit, which is the ability to deliver societal level change. Things like the Welsh Ambulance Service Trust, those kind of case studies, or Rural Payments Agency, those kind of case studies are what we're all about. It's why people come to work, is to make those kind of things happen. So that's why the move to single brand. So where are we at with it? So we're split into 3 current divisions: consulting, digital experience, and international. Consulting, you can see the companies there that came together to create that. Realistically, the crown one is Stuart from Arthurley, and that had already merged with Foundry 4, as did Human Plus. Disruption had already been folded in as well, so as Adamio. So really, this was a combination of all of those companies to create the consulting division today. Digital experience was the 3 brands, Manifesto, Decent, and Nudge, that came together to create the digital experience division. International, so Questers and Benegare. Benegare is already now rebranded to TPXimpact, and actually, interestingly, since doing that, as one of the first projects in a while, using the extended capabilities of the group, and had sold a data analytics project into one of their clients since the rebranding. Others to do, keep it simple. Kits, Red Cortex, Peak Indicators, and Swirl are still to be integrated. But the real story there is the set of integrated products that allow us to deliver on and become, an organization that's gone beyond the spreadsheet. So NetSuite, our new ERP system, has been rolled out across those divisions. Pipedrive and HubSpot CRM. So we have, a much closer consolidated view of our total pipeline. I can now go to my phone for the first time ever and have a look at things like pipeline and deals on the pipeline and see where they're at. That prior to this was a manual process. And from an HR perspective, both an applicant tracking system that operates across the entire group, so we can see a holistic view. We can begin to see data like time to close a vacancy, as well as Bob, which is our single platform for us to gain statistics from our people function, but also people to book holidays, and all those kind of things are now there and in place and can scale. So, which is what this whole thing has really been about. So, in terms of how have we done so far and what have we done, how far into that program are we? You see that we've obviously got some more brands to integrate, more work to do. But what have we done last year? We created the new brand, more work to do around our ways of working and our brand promise, and that's going on at the moment. We have rolled out those new systems that I talked about. We've rolled out the new integrated organization. We have 9 hub locations across the UK. We've got new functions around growth, bid, marketing and finance, an accountability framework, and we've won a set of awards. We won the IR Society's Small Cap Awards. We won Diversity and Inclusion Award and the ESG Reporting Award as well. In terms of the things to do, always lots to do. We've got a target of hiring 157 people this year. We've achieved 41 in Q1, which is a really great result. Congratulations to our recruitment team for doing such a great job there. We've undertaken a slight rationalization of some of the costs. As you know, when you bring all these organizations together, it's quite easy to end up with costs not quite aligned to where you want them to be. So we've done some rationalization there. We've got the integration of recent acquisitions. We've got some proposition work to do. The proposition work will enable us to really dig into that gross margin. We've got the early stages of Academy working. We've got to scale that. We've got more process improvement to do. We've got more brand investment to do. We've got a ton of work. Really the big goal for us from an operational perspective and from a financial perspective has got to be to get professional service automation software, and that will enable our delivery managers to really have the levers in their hands to be able to control project profitability, for us to really optimize resources and making sure that we've got the right people on the right projects, so that we're delivering on our commercial goals. And B Corp Cert, we've applied for B Corp certification. Our own internal audit has a scoring 91 with a pass mark of 80. There is a delay for B Corp though at the moment of sending auditors out for some reason, but we continue to hope and wait for them to do that, and hopefully we'll become a B Corp as soon as possible. So outlook, firstly, actually Q1 has been brilliant, 20 million of new business won, which if you consider all the things that have been going on within the organization, that's such a great win for us. We have at least 3 commercial clients that are expected to deliver 3 million or more this year, which is a huge leap for us. There is a huge opportunity for us in and around Microsoft. We've never taken a holistic approach to the Microsoft partnership. We now begin to do so. We begin to see opportunities that come from that, as well as the data capability that we now have. And overall, our challenges are our challenges and nothing to do with the kind of external market that's out there. We believe from an inflation perspective, our increase in efficiencies will help us address and counter any inflationary pressure that we might find ourselves under. The market itself, digital transformation, as we said earlier, is continuing to grow at a great pace. It would be fair to say that April and May were challenging. The old phrase of a plan has never succeeded or never managed to stay the same in the face of the enemy, or whatever it is. Or I think Mike Tyson did it better, which was your plan for the fight never survives the first punch in the nose, or whatever it is. Anyway, 1st of April, we operated as a new combined company for the first time, and that's when we found a whole heap of challenges. So as a consequence of that, our April and May revenue and EBITDA were challenging. However, we've been working really hard in those months to begin to fix those issues, and we see trading improvement back into June and further improvement with cost consolidation into July. So we will be heavily second half weighted. We still have great confidence in our ability to deliver the year, 97.4 revenue and 13.7 million EBITDA. Leave it open to questions.
Thanks very much, Neil. And the first question, I think Ollie covered this a little, but contracted sales backlog only increased 5% to 41.2 million from 39 million. Firstly, why were you not able to increase the backlog more? And secondly, is 100 million run rate for this year still realistic?
Sure, no problem. Shall I take these? I'll answer the next one down as well. I think we've touched on all of these points that backlog is largely as a result of timing of major contracts that had only just been won at the end of FY21 that we've obviously been drawing down in the current year and that are yet to be retendered. So that's had the main impact on that, circa 10 to 15 million in terms of the impact of that on the backlog number. And then you also asked about the Q1 number. So Neil touched on that. It was 20 million that was announced against 18.6. I think the key point there is that we've increased our recurring revenue streams over that period of time, which again support the run rate revenue. And as you asked, in terms of the 100 million, yeah, we remain confident of achieving that in the current year.
Thank you. And in your last presentation, you said you wanted to sign at least one 3 million contract per month. Is that now being achieved?
We've had a great start to the year. We've certainly done two. I'm trying to look through the list. We've certainly done two. And yes, we have an ambition to get to one per month. And I'm confident we'll get there.
Excellent, thank you. And in regard to the change programme, what, if anything, didn't go smoothly?
It's really, really challenging to deliver on this. You've got a group of small companies, people who typically join small companies for a reason. They want to work there, and in that kind of environment, and they tend to be quite worried about what the company's going to become once it becomes larger. Is it going to become this bureaucratic nightmare? Is it going to become? Am I going to suddenly find myself feeling like I'm disconnected from the mission of the organization? Do I feel close to where the action is? All of those things. And I think, we have done okay in some of those areas, but we could have done much better there. The biggest challenge is to establish the new culture. And it's really hard to establish a new culture where you're not face to face with people all the time. I personally think that's really difficult. And we've actually just hired an internal comms manager, and the impact that they're having is actually pretty good, and we begin to see some of the impact of that. But yeah, I would say that the hardest thing is being culture and getting to a new culture and getting to everybody behind the mission for what this organization is trying to do.
Tremendous, thank you very much. And you mentioned progress with Microsoft. Where do you see this going in terms of revenue and market positioning?
So Microsoft we see as a significant opportunity. None of our companies weren't treating the Microsoft relationship holistically. So one of the biggest things that's important to people who work in Microsoft is revenue attribution of Azure spend. So what that means is there's a partner in a client organization. That client organization is spending however much they're spending on Azure. That spend gets attributed to the partner. There's actually a pretty simple process within Microsoft of having your client attributed spend and reporting that and recording that. We weren't doing that, haven't been doing that in a consistent fashion across the company. And we haven't had a single relationship owner across Microsoft. Those are both things that we are going to those are both things that we're going to address or working hard to address right now. We believe that Microsoft is expecting us, sorry, not expecting us. Microsoft is, from the conversations that we've had, are excited to work with us. And we think we can develop some joint propositions that will help us improve revenue growth as well.
Thank you very much. And what areas are you looking at for the next acquisition or acquisitions?
So there's a few. The first thing is we want to be able to leverage, we want to be sure that we can leverage the relationships for further to sell the capabilities, the extended capabilities into that client base of that organization. and remains, adds to our capability in some way. So, for example, we're strong on Microsoft. We're maybe not so strong on AWS. We're certainly not strong at all on GCP. That would probably be something that we might want to look at. We want to move up the value chain, and I can tell you, we see such terrible situations occurring in public sector in particular. I would love for us to be in a conversation at a much more senior level, for us to be able to start influencing that. And there are companies out there that are selling their services into that much higher in the value chain. I'd love for us to be there as well. So those are some of the areas.
Thank you very much. And are you going to wait for the share price to improve before any further acquisitions, which will involve equity, either 100% or in part?
No, we are. We've moved to a model that is part cash, part shares. We do see ourselves, potentially moving to a model that is 50% cash, 50% shares. Every acquisition that we make, even at the valuation level that we're at today, will be accretive. So we'll add shareholder value, we'll add to EPS. And that is the thing that we're absolutely focused on, is continuing to add to EPS. We're not going to slow down and wait. Where we see the right opportunity, we will continue to move on that right opportunity.
Tremendous, thank you. And can you talk a little about how you see staff utilisation and use of contractors for the coming year?
Yeah, so this is one of the efficiency opportunities that we see. Some of our companies weren't they weren't tracking time properly. In fact, one or two of our companies, there was somebody in the middle that was doing all the time tracking for everybody. They kind of knew where everybody was, and so they'd fill in their timesheet for them. And that became the norm. As you scale, you can't do that. You need individuals. You need individuals to do their own time tracking, so that you capture that time efficiently. And you can just imagine that if you're not capturing your time on the day itself, then the opportunity for revenue loss or revenue leakage is amazing. And and so just that one move of really pushing through to timesheets and making sure every individual on billable work does track their time properly, accurately, on time, so that we are capturing that. So we see improvements in utilization as a consequence of that.
Tremendous, thank you very much. And that's obviously an example, but can you give any other examples of what's changing that will result in a stronger revenue performance in half two? And what's your organic growth expectation for this year?
So our organic growth expectations for the year remain as per our commercial vision of 10 to 15% like-for-like organic. I think analysts have 10% modelled in, and we anticipate hitting that expectation at the very least. In terms of what we're doing differently and what's happening. So firstly, a growth team that's firing on all cylinders. A sales organisation that's really focused on making sure we take our message to our existing clients. That is, by far and away, you've seen the revenue bridge early on of kind of recurring, repeat, and net new. That by far, that repeat piece is where the biggest growth opportunity is. We've got the relationship, we're on the framework, we've got everything in place. We need to be selling our entire capability or broader capability into that, and a really strong focus on that, including myself. So I've probably met 3 of our largest clients in the last week. When we were a holding company model, I typically didn't meet those large clients because it was each company had its chief exec, and they held the relationship, and it was kind of them that was driving it. In this model, we can bring that story together. I mentioned I was with the chief exec of Digital Health and Care Wales. I was with Legal and General. I'm with DEFRA on Monday. The opportunity for us to really scale that is there, and that's what's driving the confidence in the year. Is those conversations that I'm having with those clients that are literally laying out opportunities in front of us.
Tremendous, thank you. And that's the end of questions, but there's just a comment saying, great job, guys. Please pass on thanks to all the staff.
Thanks, Scott. Just say thank you to that.
Neal, do you have any closing remarks?
No, I guess, we delivered a great year. We've now delivered a series of years where we've delivered pretty much ahead. We've increased expectations during the course of each of the years. I have to say that this year, the beginning has been quite challenging. I have every faith in our management team to that they've already begun to address the issues. We saw the issues. We're already addressing the issues that we saw. You see that playing through in the June numbers, and we see that playing out in some of the things that we're doing into July and beyond. Meeting those clients has been just phenomenal in terms of validation of what we're doing. Seeing them, I was, as I say, the Chief Executive of Digital Health and Care Wales, an organisation with a considerable budget. Wales spends something like 10 billion on healthcare. The Welsh government does. And the outcome of that was a 4-hour workshop with her leadership team to map their strategic priorities with our capabilities and see what we can do for them. You just don't get those opportunities typically, and so we're super excited for the year ahead.